Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Lia Holmgren. How you doing today, Leah?
Hi there, Kirk. I'm good, thanks. Thanks for having me on your podcast.
Yeah. Thanks for joining us. So people don't know you. Maybe you could tell us a little bit about your background.
Sure. So I was born in former Czechoslovakia. I've been in the US about 17 years, and I'm currently working as a full-time trader, stocks and options trader, and I used to work as a psychotherapist in the past. So it's kind of an interesting mixture. I help people with approaching the markets from the psychology perspective and discipline. And I also am very passionate about trading. I trade every day, and I love that. I love the work I do. It's
Nice.
fascinating.
How
Yeah.
did you get into trading? I mean, you're a psychotherapist. That sounds like a pretty interesting and fascinating field. Like, what brought you into trading?
I was always really good about money, and my parents raised me really well in this topic. So I was always investing and saving money and investing in different products and real estate and markets. So I've been around this finance part for 20 years, and 5, 6 years ago, I really enjoyed the volatility in the market. So I kind of figured, why not learning more about it and be more active with this part of my life.
Nice. But trading though, I mean, like trading is a very unique field that a lot of people don't get into. It's different from being an investor.
Oh,
So
absolutely. It's
yeah.
completely different mindset. So I'm still investing. Maybe 80% of my money is full-time invested, but I'm active around those investments with selling options on my long-term holdings. That's my favorite approach. I think I just liked risking more than we have to say that trading it has some sort of risk and more than when you invest, I think. And I'm not scared of that. I really enjoy that part of trading, and I also enjoy dynamic things. And in markets, every day is a new day, and I thrive in those environments. And it's not for everyone. When it comes to psychology, I really learned in those years that I'm not smarter than most people, or I'm not special why I do this job, but what I am extremely disciplined. And I've always been like that. And I think if you want to be a trader or an investor for that matter, you have to have a discipline. If you just want to even invest in ETF funds, right? You have to have a discipline to be consistent with your buying, with your monthly purchase of ETFs, with not selling when the market goes down. You have to have your emotions in control. And that's where most people fail. That's why when you're asking about the psychotherapy and psychology, the human mind works certain way around money and around relationships. And I saw an incredible link and synchrony between those two. And that's why I think it's fascinating to be around money, but using a lot of the knowledge I had in the past when I was helping marriage as a marriage counselor.
Nice. So you work with other traders or you're just using this for your own benefit?
I do work with traders. Yeah, I work with many people that want to do coaching. They want help. I also help as a performance coach for people. They've been in finance and they've been New York Stock Exchange traders for many years and hedge fund traders. A lot of these men, mostly, there are not many women in this environment yet. I hope it will change, but a lot of them need some sort of support, especially when you get to the point when you have a losing year and you start being on a tilt or you're spinning out of control. There are a lot of challenges that traders have, even if you've been doing this for decades, right? So I like to help in these situations, and I also like to coach people how to start and not lose money because I think it's very traumatizing to see so many people losing a lot of money and following who knows whom on social media, not understanding the basics of risk management.
So why do you think there are not more women in the field?
I think women don't like risks. I think naturally men are more risk taking, right? When you look at it from past of humanity, men were the ones that were hunting and they were risking their lives by kind of trying to hunt a mammoth, right? Just looking at history. And a lot of my female friends and women I coach, they are extremely scared of the unknown and of the markets. And women like to seek stability and security, right? That's kind of like in our genes. So I think that's the reason why a lot of women are worried of the markets. They would rather buy real estate and have something tangible, like a house or a condo or something like that. That's my observation from what I've done in the last 20 years. That every time I talk to a woman, they're like, "Oh my God, no, I don't want to invest in the markets. I want to buy a house." You know, and also it has to do with this, I think, the culture and the society. Men are usually the ones who were the breadwinners and they were controlling the money. And it's all changing now. Like more and more women are approaching me, please, can you help me with this? I really want to understand money. I think the shift is happening, but it's the culture and how we are predispositioned mainly.
Yeah, it's interesting because my understanding is, I mean, women who are investors or traders tend to do better in many ways. You know, like you said, they're risk averse, so that can be harmful
Mhm.
to what they're doing, but they tend to be more thoughtful about their approach, and they tend to be less tied to the emotional elements of it, like men are. Like men are, like you said, they're more into risk taking, but then they flip flop. It's like, I'm going to take
Yeah.
the risk, and oh my God, I'm going to lose everything, and take the risk, and I'm going to lose
Yeah.
everything. Whereas women seem to be more balanced.
Yes.
I don't know if that's what you see, but that's kind of what I've seen over the years.
Oh, yeah, absolutely. There are even research studies that are confirming that the worst investors and traders are married men with babies or kids. I think they tend to freak out the first ones when something happens in the markets. And the women are, they're not many, but once they are traders, you're right. They, first of all, we don't have ego as men do. That really helps because a lot of traders I coach, they lost so much money because of their ego. You know, like there's the book, you want to be right or you want to be making money. And it's perfect. It's such perfect sentence. Oftentimes we're like, I have to be right in this trade or in this investment. I got to be right. But you're not realizing that the investment or trade is drowning and you need to get out. So this is a problem men have oftentimes. So yeah, I agree with you on that. Women are doing better and maybe, as you said, they are a little bit more patient too.
Yeah, well, most women I know are more patient than men, but
Yes. Yeah,
um,
surprising, but it is. It's true.
so in working with other traders as a performance coach, what do you find are some of the more common challenges that people come up across that you have to address?
So number one is the risk management. I'm absolutely shocked how many people do not understand risk to reward. I'm a math girl, although I studied psychology, I loved math and physics and all that stuff. And I just like look at the probabilities. And a lot of times people don't understand that in order to win this game, you are not really focusing on when you're right and what's your win rate. You're more focusing on truly just cutting the losers fast and staying in the winners as long as you can and finding those setups that have a potential to run. So people don't understand the risk to reward perspective. That's the biggest problem. And then of course, like risk, how much they can actually allocate into a trade. And I have a simple formula I teach everyone that's life changing. Like everyone comes to me after they say, oh my God, this is life changing formula for the retail, right? Like when you work for institutions, you have certain rules there that you follow and education. But as regular retail traders, they have problem with this. When you're then working with people, they are working for institutions, they have their own funds. That then more is just like really the ego and balance between work and life. When you're having a difficult year, what do you do? Because people tend to spin when you get on this tilt, right? It's the poker expression. Your judgment is completely clouded. So in that sense, you need to really take a step back and start from scratch, start thinking clearly. And it's very difficult for many people. So these are like the main things I see.
So when you're trading yourself, you said you use options on long-term positions. How do you trade options? Do you have certain strategies that you like, or what's kind of your preference?
So I personally completely hate short-term options. A lot of the younger people that I work with, they all want to trade short-term options because they're very cheap, but the probability, again, I'm a probability girl. The probability of success is very low. So when I trade options, I usually buy at least 6 months or a year or 2 years even in expiry. I love it because of the leverage, right? It offers.
Mhm.
And I trade very high quality. I buy these options, I call them leaps if they are a year and longer for high quality tech stocks. And then I can even sell covered calls on those leaps. So I prefer these strategies when there is a really strong market, like we've seen after election. There was a beautiful time when you could sell covered calls on your holdings when we were reaching those kind of euphoric levels. When I sold covered calls on Tesla, on each 100 shares of Tesla, I would get $1,500 for the covered calls. Of course, they expired completely worthless for the people that were buying those crazy calls. I was selling them. Of course, when the volatility is increased, that's what I think will be this year. We're going to have a new shift in the government, new president. So we're going to have, I think, increased volatility. And it's going to be beautiful to sell covered calls on your holdings. If you're just a long-term investor, why wouldn't you make extra money every week or every month by just selling some of your covered calls at price which you wouldn't mind selling? And then I like to sell puts too. I like to sell cash secured puts when I, for example, have a position that I get called away on, right? That I have to sell these 100 shares for the call I sell. I like to allocate myself back to those positions through puts. So these are kind of my basic strategies. If I'm too worried and I just want to make some money, I do spreads. So I do put or call spreads if I don't want to get assigned in, for example, some stocks that were volatile. Like last year, Tesla was pretty crazy. Years before as well, I would sell put and then I would buy put below that strike price. So in case that I get in the money, I have some sort of a risk that is defined, right? Because when you sell cash secure put, then you have undefined risk, so anything can happen. So again, this is not a financial advice. These options are pretty complex. People need to learn a lot about this, but these are my strategies that I use.
Okay. So how do you look at position sizing with options?
So if I sell cash secure put, I always, as I said, I like risk, but I'm also always try to have defined risk and kind of know what is the worst case scenario, because people like to think about interest, how much can I make? But I always ask them, how much can you lose? That's the number one thing you have to look at. So I sell as much as I can afford to buy in the worst case scenario, right? That would be for the cash secure puts. When I buy options, it again, it's like an investment. If I buy leaps, I treat it as an investment. This is a company I want to own for next year. I have the leap for those shares, and that's pretty much how I look at it. What can I afford? What can I afford to buy in case that I have to? What is the situation of my portfolio? A lot of people tell me for smaller accounts is really difficult strategy. I agree with that. I again have a opinion on small accounts. If people really come to me with $5,000, $10,000, they want to trade short-term options, I kind of get really, really uneasy about it, because I think everyone needs to have some sort of a cushion in long-term account, at least in order to trade and gamble. Because this kind of trading to me is gambling. I'm sorry to say that. So yeah, so that's how I look at it. And when I do trade with equities, I usually try to risk at max 1% of my account on a trade. Doesn't mean that I allocate 1% of my account, but the risk that I'm ready to lose on the trade, which mean where I buy the equities when I have my stop loss, that's 1%. If you're a professional trader, you can do 2%. If you've been trading for a longer term, okay, but 1% is kind of like what I do.
Okay. So when you're buying leaps, are you buying like at the money, in the money? Like, well, how do you characterize that?
I'm buying in the money and at the money. Yeah. I don't really buy as much of the out of money options. Again, for me, I treat it as an equity with better leverage. So I like the Nancy Pelosi style. I like to buy in the money or at the money and just hold. And again, like I sell covered calls around those two when I see there is a strong move. Like recently, I bought Citibank leaps last year. I just now reached 200%. And I got out of this position. It was June expiry. I could have stayed maybe longer, but to me, 200% is a pretty decent return on investment. And I also always tell people, take your profits, especially with options and leaps, because once there is a turnaround in the market, you might not make it back because the theta will kill you on those positions. And that's what people also forget when they buy options, that the time decay will kill them at some point. And it's, yeah, with the leaps, 2-3 months before the expire, it starts decaying faster.
So you're buying at the money or in the money leaps.
Yes.
You're not getting
Mhm.
the full one to one. You said you're putting in as if it was a position. So,
Yeah.
if you have $60,000, you're buying one leap contract for $60,000, the S&P 500 as an example.
Yeah.
Um, and that gives you the performance of basically half the
Yeah.
performance of the market. Um, do you ever leverage up, leverage that up? Because if you're doing it half, then you're really not getting the benefit of the full, 60,000 being the S&P. You're getting a
But you
much
also
lower
pay
risk
less,
and
right?
what's
Um,
what?
if I leverage up, sometimes I do, but usually again with equities. If I see I'm in a strong trade, I will, if the trade is going my way, I will add to the trade, which I learned last couple of years to do that way. That's what I do with the options. I just stick with it. And for example, I have leaps on Tesla. I have leaps on Amazon. I have leaps on Nvidia. I have leaps on Apple, which now Apple was not doing so well last couple of weeks. Um, and then yeah, that's pretty much what I do. I never bought SPY or stuff like that. I don't really trade the indices though.
Okay.
Yeah, I don't trade those that much. I just don't see a reason why would I trade QQQ. I can just trade the individual stocks, the biggest ones from the index and hold it and
I guess
trade
part of it
more.
would be the size. I mean, if you get a company that has $1,000 per share price, that might be an
Yeah.
impediment to trading it.
Yeah, that's why I do it really because the leaps are cheaper. And again, if I would want to have 100 shares of really expensive company, as you said, it would cost a lot of money. It would hold too much of my capital. So I'd rather do the leaps in those situations.
But isn't that kind of the same? I
It's
mean, if
moving a
you're
little bit slower, but yeah, depends. I like it. No, it's not same. Like for the Tesla, I could look how much I paid, but would I have bought the shares? I would be $30,000 from my capital would be gone, and with the leap, it was I think 10 or something like that. So
right.
yeah,
Okay.
it's much cheaper the leaps
All
when you
right.
buy them. Yeah.
Um, all right. And then do you invest in individual stocks as well, or
Oh
you
yeah,
you okay. So
mainly yeah, yeah.
so what's your approach? I know some people are swing traders or day traders, and there's all these different styles. Like, how would you characterize your style?
I don't really day trade that much. Only when there is like a really beautiful setup, I would day trade in and out. But I like momentum swing trading. I'm trading breakouts mostly. That's like mainly what I do. So when I have chart pattern breakout or I have a certain level breakout, I will trade that. I like those. Sometimes I will trade reversals on very strong trend when the stock is retesting. So these are kind of my things, and I love momentum. I don't really have too many indicators. I have volume and I have the trend line or the resistance line that I focus on. For me, volume is really everything. If there is no at least 50% or 100% more volume than the days before, then I would not take the breakout. That's kind of what I do. And then I invest in individual companies. I have about 20 companies I'm invested in, and I've been investing in them for last 2 3 years. Sometimes I change the portfolio and some of them I sell. As I said, sometimes it happens that I get called away on some stocks, but it doesn't happen too often with the covered calls. I usually sell them Delta 25 and lower. So it's not as often that this happens. Yeah. And the companies I'm holding, selling options around. And that's pretty much my approach.
Nice.
Yeah.
Nice. Yeah, I mean a delta of 25. I mean that's
Yeah.
what's that, a 4 to 1 approximately
Yeah, yeah, it's
upside.
about 25% chance to be called away. I like it this way. Also, of course, we can't forget the tax situation, right? With the short-term and long-term hold. So that's another thing people have to consider. If you're like holding something for 7 8 months and then you would get called away, it's kind of a shame. You could wait 12 plus months and have different tax implications on many of those. But again, I'm not a tax advisor, so everyone needs to look at their own. But these are all the details we have to think about when we are trading. It's not that easy as people think it is, right? To really, you can beat the market, but then you pay crazy taxes after that. And Right. Many things come into this play.
Yeah, taxes are a nuisance in dealing with this. I
Mhm.
mean, how do you prioritize taxes over performance, or how do you look at that if you have to make a trade?
Honestly, I've done it once when I was up on crypto in 2021. I think it was 21 or 22, 21. I was up so madly on crypto and I said, no, I don't want to pay the tax on this and let me wait and no. And then it all just dumped in 22 and I was like, I would rather pay the taxes. So, it depends. If you're trading every day and you're a full-time trader and you really are doing well, then I would take the profits, I think, personally, if I'm up a lot. And again, if I said if it's something like Amazon and those stocks that I have really long-term view on, I'm more treated as, you know what, it's just where I put my money into when they sit there. And when I need the money to buy something, like I bought 2 houses in the last 4 years, I sell the stock and then I deal with the tax. But this is how I look at things.
Yeah. Okay. Yeah, that's good.
Yeah.
That's good. I appreciate that. Um, all right. So, I mean, your different strategies definitely fit a lot of different buckets. I mean, the covered calls are certainly a way to generate extra income. Are you also still working as a performance, like, is most of your income through the performance coaching, or is this just kind of
Mhm.
like stuff you do, or
I don't do much of the coaching because I'm just so busy with the markets and research all day. And with my group, I have trading group, that I really spend most of my days with that. And the coaching one-on-one, I don't do so much anymore. It's just really time consuming, I think. But I focus fully on my trading group and on my own performance a lot too.
nice.
Yeah.
So, okay, so you're selling calls and puts, generating income, you're doing leaps, I assume for performance.
Yeah.
Where do spreads come in? I mean, spreads are one of these weird things, and I had um, I, I've always it's always been kind of love or hate relationship with spreads with a lot of people I talk to, and myself included. Like, how do you look at spreads? Like, where do you see the value of using them as opposed to some other vehicle?
Well, you have defined risks. When you sell them, you know how much you're going to make, you know how much you're going to lose, right? So, as I mentioned, Tesla, right? Tesla is a little bit more stable now, but when you look at Tesla 2 years ago, that stock was completely erratic. And I loved selling put on that stock because the volatility was insane and you get a lot of money for the premiums. But then you might wake up and phew, the stock is $20 below your put strike. So strike price. So that's when the spreads come in. I said, I don't think that Tesla will get to this price, like when I sell the put. But if it does, $5 below, I have my protective put that I buy. And that's how I look at it. It's just like an insurance that I put on the put that I sell, I buy one. So I feel safer about that trade. It just helps you to define risk. And when you look at statistics, option traders that really tackle the spreads, they are the most successful option traders out there.
Okay, cool.
Because again, like you can be selling a bunch of puts through the year, and then you have one bad one that will take you gains from 30 or 40 you sold, and it really happens. So that's why when some companies you feel uneasy about or they have kind of like a difficult time, you can do the spreads. So you make a lot of money with the premium, but you have kind of you will put you know the protective put below the strike price. That's how I would do it. The same with calls. You can do call spreads as well. You can sell a call and buy a call higher just in case that the stock decides to go absolutely mad and go higher. Your loss or opportunity cost is not as high.
So, one of the challenges I see is, you're picking a directional bet, which, like you said, defines your risk. Are you typically selling spreads or buying them?
Selling.
Selling.
I
Okay.
like selling. I'm a
I
option seller. I
get it.
sell. Yeah.
What's your target when you're looking for that? Are you looking for like a 3-to-1 return, or what's your
Yeah.
target with those?
Yeah. So well, when you're selling options, right? Um, the probability of your success is really high, but the risk to reward is terrible. And people like don't again have to understand this, which means sure, I have a huge probability I will keep the premium, but if I don't, I will lose probably 3, 4 times the money. So yeah, that's about where the option selling falls in. When I'm selling them, that's usually the risk to reward is 1 to 3 or 1 to 4. But again, from like I sell thousands of options every year, um, and maybe I literally have like 10 of those that go into money, and I have to execute that. So it still
Okay.
makes sense for me. Yeah.
Okay.
And I love trading options around the crypto stocks because that honestly, you can make so much money with this. And just selling covered calls on my like Mara holding or on coin or any of these things. They're moving like yo-yo. It's unbelievable. It's like one day up 10%, the next day down 10%, up 13%. It's like the implied volatility is 150% and more on those. And really just like selling covered calls on Mara, I can like literally live on that if I want. And it's a cheap stock too. That's the best part. And usually I'm selling a month out date wise, but with this guys you can do weekly or bi-weekly, and you're just getting incredible premiums on those.
I thought you didn't like the short-term ones.
Well, I don't like to buy them, and selling is different, but as I said, I only do 2 weeks around the about like Mara or coin or this crypto stuff. Again, like we have to distinguish between selling and buying. Buying short term I would never do because that's like gambling. You're gonna definitely lose your money, or like a huge chance you will lose your money. But
Yeah.
if you're selling them, you're keeping the premiums. That's what I do.
Interesting.
And yeah, again, I do 30 days minimum when I sell options, but on the crypto, you don't need to lock yourself so long because they're moving so unpredictably. One announcement and these things will fly 30, 40%. So why would I lock myself in such long-term trade around those? These are like special, they're like special trading vehicles that I look at. Super high beta.
Nice. Yeah, I've not delved into the options market with crypto or crypto companies that much because to me, there's a lot of conviction, which is good because you get a lot of people making dumb decisions because they believe, and that creates volatility. And very curious to see what happens this administration. What do you think, getting into that, what do you think people should be thinking about in 2025?
So my trading plan and what I think is going to be next year or two, we will see a lot of chop in the market and a lot of volatility, meaning it will be difficult for swing traders and momentum traders like me because, as we know, our new president likes to tweet and he likes to say things that are pretty violent for the market. So all my swing trades can be ruined and I get stopped out immediately. So I think what will be the strategy for this year, truly just research the companies that you believe in, have a future, and you want to invest in. Wait for the times when we're going to have 10, 15% correction, most likely soon this year, next year. Of course, it happens almost every year. We have 10% sell-off or even correction. So I will be waiting for those to buy more of the companies that I research. Be ready for those days because the opportunity comes for short term. Adding to those positions, selling options around it. On strong days, I will be selling call. And on weekdays, I might be selling puts. And then just really, if people can day trade, they should day trade. I don't personally day trade. It's too much work for me. I don't like that stress, but there are some people that might love it. It will be a beautiful market for like scalping and futures trading, I think. Yeah, so that's pretty much it. I think volatility is back. We're gonna get higher, juicier premiums for options because like last year, the volatility was most of the year so low that it wasn't even making sense to sell options, to be honest with you. So this is gonna be back. It's a new market we are having. So that's kind of my thinking for this year.
Nice. What do you think in terms of global macro kind of views? I don't know if you look at that, but I mean, there's a lot of
Yeah,
implications with the new
yeah.
administration globally, and I don't know if that impacts what you do.
I'm not happy about that right now because I do have certain amount of my long-term, like 25 years and longer portfolio allocated in emerging markets and in international markets, which right now is not doing that well because dollar is strong, and if we impose all these tariffs on everyone around, it's going to be kind of really hard for these companies. But yeah, we will see if really this administration will do it. I mean, they're threatening to do it. We will see what happens. Last time it didn't really happen. When it comes to certain countries, we did really well last year with Argentina. That was our huge trade we had. That was absolutely amazing to see all the Argentinian stocks just flying. We'll see if the trend continues there. China is just that. It's not doing anything. I wouldn't touch it personally. Yeah, but again, we'll see. Nobody knows what is going to be the final decision. I don't think this is, as I said, this will be very unpredictable couple of years or 4 years. So we don't know. But emerging markets and international stocks, even Germany, when you look at it, is not doing so well. Yeah, could be challenging with this administration to invest outside of the US.
Yeah, yeah, I would say that's a, I would
Yeah.
say that's a, not a certainty, but pretty close to it. So,
Yeah.
well, cool. Well, I really appreciate you coming to the show, Leah. Give us some final thoughts that people should be thinking about, and where can people find more about you?
Well, my company is called Trading Mindset and Data. That's also the website. And as I said, we focus on a lot of analysis. We have custom-made scanner we built on Bloomberg Terminal. We do a lot of research before we buy. And I'm working there as a head trader and a coach. So that's the website. People can contact us, sign up for a free newsletter I write every Sunday. Yeah, that's pretty much it. Trading Mindset and Data. Thank you so much.
Awesome. Thanks for coming to the show, Leah. I appreciate your insight, and yeah, we'll look to have you back on the future.
Awesome. Have a great day and thanks for having me. Have a good day.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Leah. Appreciate her coming on the show. Now we're into the panel portion of the show where we have our very own Jeff Hewlett. Hey, Jeff.
Hey, hey, great to be here. Good to see you, Kirk. Good to see you, Doug.
Yeah, yeah. Great to have you on here. And we also have our very own Doug Hagren. Hey, Doug.
Hey Kirk, said see you regularly, but it's been a while since I've been on the panel to critique other people, so it's good to be back.
Yeah, yeah. Glad to have you. Got to mix it up a little bit. So, Jeff, what were some of your takeaways from the interview?
So you kind of have to put in a little bit of perspective here. So I'm a behavioral economist, but I teach personal finance. And so this is sort of where my head goes with that. So one of the big things, first of all, that I really loved about the interview and listening to her is, and I kind of relate it back actually. So I have 4 children. I have 3 boys and 1 girl. And my daughter is a data scientist and a financial engineer. She works for Capital One, right, and a risk manager. So, Leo made a comment about, like, she's kind of saying, I'm not normal, right? And so I kind of raised a not normal young lady too. And I kind of get not normal. And she talked a lot about things like, you know, and you guys kind of hit on this at the beginning, like the difference between like nature and nurture, and are girls just genetically geared towards not taking much risk? Is there a cultural part of it? And it really made me think a lot about sort of some of my experience in that. And there's a ton of research out there, and it's just like one of the things that kind of bugged me a little bit about it, but something that really stuck with me, which is all the research says, and in the few societies in the world that are actually matriarchal, there is no evidence that there's any genetic predisposition of women to be less willing to take risk. All the studies say it's all about how we raise our children. And in the United States is a patriarchal society. We raise our children, and this is what actually a lady named Reshna Saujani said, we're raising our girls to be perfect and our boys to be brave. Right. And she kind of goes into how we do that. But to me, that's at the core. And so that kind of took me back to my daughter a little bit. And I kind of was connecting a little bit with Leia. She's probably not that much older than my daughter. That, somehow, through her upbringing from East Europe, wherever she was from, she was raised to be brave. And she not only has the mathematical mind, but she has that personality that allows her to do what she's doing. And I thought that was really cool.
Yeah, it's interesting. I mean, nature versus nurture. I think obviously that's that's the debate of the ages for sure. But I appreciate the perspective. Doug, what were some of your takeaways?
Well, yeah, actually, do you mind if I kind of just
Go
a
ahead.
little points and counterpoints on that? So I agree completely. And there's actually some research that you were talking about. Egley and Wood in 2012 wrote something called the social role theory. And that explains how gendered societal expectations shape risk preferences. And they found, similar to what you said, that women were often raised with stronger messaging around safety, security, caregiving roles. That influences financial decision-making tendencies. There is some studies out there, though, that, Sapienza et al. 2009 talked about risk aversion and potentially tying that to higher testosterone levels, which have led some people to take bigger risks. Actually, the Journal of Finance found, Barber and Odine wrote in 2001 that men trade 45% more often than women, and that over trading actually reduced men's net returns. That women had tended, whether it was social or it's testosterone, had been more conservative. They actually have achieved better returns overall through less frequent thoughtful training. I'm sorry, trading. And so, I think, there's some experiment, there's some studies that go back and forth on a little bit of that, maybe some biological, but I do think that, again, predominantly there is absolutely from the research some influence that there is that societal kind of training. But in general, it has led to better, whatever the cause was, and it has led to some some better outcomes in terms of the results of when women trade versus when men trade, because of why, but how they are applying that risk. And I think that leads me to a little bit of a segue here about the most important thing I think that isn't, goes into any type of decision making, whether or not it's trading or other things that you do in your life, the necessity of having a plan. Okay, winners versus losers, and I think that was a big takeaway for me. This is where people shine intellectually and professionally. Every elite trader, regardless of style, has these things in common. They have a plan, they have predefined rules, they have a discipline to execute that plan no matter how emotional the market gets. The losers, they chase trades, they abandon systems, and they act on emotion. And I think the clearest dividing line between successful traders and everyone else is the presence of that plan. Winners don't just have the plan, they follow it. Losers improvise, they react, they hope. In high risk trade environments like options or crypto, which she talks about both, you're not just competing against the market, you're competing against your own emotional discipline. One thing I say is if you go into trading without a clear plan, the market will hand you one. It's called bankruptcy. So, you know, so and the one thing I think, and I'll turn it back to you, the one thing that I got concerned, I mean, hearing her describe her approach to selling options made me think, is the real skill in trading not the strategy, is in trading not the strategy itself, but the discipline to stick the plan when everything else gets volatile. And she loves that volatility. I did sense a little bit in some of the questions you asked her, Kirk, whether or not she sticks to her discipline all the time, because I felt like when you pressed her on things like, well, I don't like short-term trading. Oh, then you came back. She said, well, she loves it with crypto. Well, when I'm selling, but not when I'm buying. So, may have just been clarity in the question there, but I kind of sensed a little bit of concern whether or not she sticks to her discipline, or that she, truly has mapped out the way. I think I sensed a little bit of emotion there in the way she trades, but that just may have been the way the questions were phrased and answered.
So I'll put some context around it, and I don't have a background for what she's specifically doing other than what we heard in the interview. But I know when it comes to options, people get confused a lot with options. And you mentioned one thing, Doug. You mentioned, well, options being in the risky category. The funny thing about options are what you want them to be. They could be hyper conservative or they could be hyper aggressive. And the challenge is people look at options as leverage. So if you look at options as a way to lever up and make lots of money, it's like you said, yeah, you can make lots of money, you can go bankrupt. You can do both, right? It's like investing in futures. Futures is one of those things. I remember the old movie Trading Places, where you got the rich, the dukes, the rich brothers, and they were taking advantage of everybody, and then at the end they made them bankrupt. Well, the way futures works is you have lots of leverage, and you don't have to put up that leverage, but you have to put up at the end of the day. So you can do whatever you want during the day, but at the end of the day, if you can't cover it, they're going to take all your assets. They're going to seize your house. They're going to do everything. That's why futures are dangerous, is because if you get over your skis too much, you can really get taken to the cleaners. With stocks, all you can lose is all the money you put up. So they can't go take your house. If you lose all your money, that's all. That's all they can take. Um, Options, similar. Like they don't. The whole point of options is they were created to manage risk, not to create risk. Now, with any market, there are buyers and sellers, and there are people who make a market. There are speculators, there are risk managers, all sorts of people who make a market. And there are speculators, and some of them do crazy stuff. And there's nothing wrong with that. It's your own choice as an investor. But if you use them how you're supposed to, so I'll give you an example. Like when I started trading options when I was in college, I learned about them. I was like, I could make some crazy money. And I was a college student, didn't have much, but I was like, hey, I'm going to go, it was 99. So like, hey, why not? Let's just make money like everybody else. So I tried them. I leveraged up. I should have bought one option. Instead, I bought 10, and lost everything on that trade because I didn't know what I was doing. And I was like, okay, well, that was stupid. I'm not going to do that again. And so you learn these lessons over time, and you realize, okay, people say, if you want to buy 100 shares of SPY and it's trading at, it's 600, let's say 600 a share. So I'm buying one option, right? One option equals 100 shares of, SPY for this example, right? So it's going to cost me $60,000, right, for that trade, right? So I could buy one option and have that be the equivalent, effectively, of 100 shares of the SPY. That's what I should be doing. Now, now that might cost me, let's say, $1,000 instead of 60,000. Now, I could go out and buy 10 of those contracts, would cost me 10,000. Now I've got the equivalent of $600,000 of SPY instead of only my 60. Now, I could make a lot of money that way, or I could lose a lot. But that's what we call leverage, right? You do that because you're speculating. But options are not risky. They have the potential to be risky depending on how you use them. Now, there are things called, I'm not going to go down the rabbit hole too much, but there are things called spreads and other things which really reduce your risk, right? Or covered calls, which is effectively one of the most conservative things you could do. There are many ways that you can invest. The problem with options is not the option, it's how people use them,
Yeah. I
right?
love that. Yeah.
So
Like most tools, right?
yeah, yeah, it's like a hammer's great for banging a
Yeah.
nail into a board, but if you
Yeah.
hit it on your head, it's dangerous. They're not going to ban hammers because somebody hit themselves in the head, right?
Right. Right.
So
Right.
that's similar to options, and options were created to manage risk for institutions, and people use them, and they should. I use them all the time, and they're a great tool. So, if I use them properly and the market goes to zero, I could protect most of my wealth if I do it properly. Or I could lose it all if the market doesn't go anywhere. It just depends on how you use them.
Yeah.
And the way I look at options is if you have a theory for where you think the market's going, you could come up with an option strategy to deal with that. If you think the market's going sideways, there's a strategy for that. If you think it's going up, there's one for that. Down, there's one for that. Whatever you want. You think it's going to go up one month and down next month or whatever, you could create something that does all of that. It's really interesting for math and engineering geeks because there's a lot of math behind options. And if you go down the rabbit hole and you're really into it, and I know some people that are, they love it because it's just math. It is probabilities and math. And so if you like that, it's a great tool for you because you're going to understand it better than most. If you just look at it as, hey, I want to make lots of money, I would stay away from options. That's not how you should utilize them. And I can't speak for Leah's background, but I know generally everyone's got a way of doing it, and you have to find your investor psychology that works best for you, that doesn't allow you to make a lot of mistakes and help support. So by the way, one of the reasons I use options, it supports my it bolsters my strengths, and it kind of I should say it bolsters my weaknesses. So there's areas that I'm weak, and it compensates for that and allows me to invest how I want. So for instance, I have a tough time with stop losses, right? A stop loss, you put it in the market and the market will take it out. They'll
They
take
get
it out
jumped.
and it'll
Right.
go the other way. So you can't put it in the market. So you got to keep
Especially
it
with
in your head.
ETFs, never use stop losses, or especially trailing stops on ETFs. People, anybody listening, do not. Anyway.
Yeah, 100%. So you can't. So what do? I got to keep it in my head. Well, I can put it on a piece of paper, but it's still in my head, right? I still have to emotionally do this. So if a stock goes down 20%, I'm like, I know I hit my stop loss, but you know what? It's really close to bouncing here. All right, it goes a little lower. No, it's definitely going to go, and you keep doing this mental game, and I have a problem with that. It's one of my biggest weaknesses. So what do? I use options. It compensates. So I don't care if the thing goes to zero. The option has compensated for that downside, so it's effectively a stop loss built in.
Yeah.
Now,
Jeff, go ahead, Kirk. I thought you were
yeah,
on time.
no, I was finishing up. So anyway, point being is there's all of these things are tools. You need to understand how to use the tools for your intended purpose. Go ahead, Doug.
I want to give I have a little fun history lesson on that, but I didn't want to hijack. So Jeff, I didn't know if you had a thought before I jump in on anything.
Yeah, the only thing I think one of the things you said, Doug, which I thought was really interesting about having the discipline, right? And sticking to your discipline, having a plan, plan the work the plan, right? And that's the fail point, is where, emotion or whatever it is, it gets away from you. And honestly, like, here's one thing though, I kind of want to bring up, which is we've got the three of us, right, on this call right now. We're weird. And what I mean by weird is, we're
My
reasonably.
kids tell me that all the time, by the way.
Speak for yourself, Jeff.
Okay.
I'm weird.
Well, we're weird
I'm
because
eccentric.
we're reasonably wealthy people, and we're reasonably sophisticated in understanding of mathematics and our approach to the market, right? And here's what I mean by that. So maybe we're in the 1%. I don't know. Pick a number. Some very small percent though, for this weirdness category. A good weirdness category, guys. But so I teach my class at JMU for the 99%, right? So I'm really saying, okay, guys, I'm going to show you a discipline, and I'm going to show you a strategy that actually focuses on making time your friend, right? And that's really what we get on. So when she was talking about the different strategies and the different options and the use of options, that's actually something that I spend very, very little time on, because to me, that's a level of sophistication that I think most people just won't achieve. And I'm just being real honest, not that they can't. And what I'll talk to them about is like, hey, look, you're a normal person. You're going to work a regular job. To compete against people that are in the market doing this every day, that are looking for weakness and are looking to trade against you, you've got to do this 60 hours a week. You've got to be dedicated to it. So I'm going to teach you as if you're normal, as if you've got a job and you're not doing this all the time. You're doing it maybe an hour or so, a little bit. You're trading, you're doing your stuff, but that's the strategy we're going to focus on. So anyway, so that's where I was, sort of where my head was going, and I was struggling with just a little bit, was just like, okay, how like she talked about leaps, and she talked about her option strategies, and then some of the different things she's talked about. But then I was just sitting there thinking to myself, okay, but how do I make this relevant to people that aren't nearly as mathy and kind of well versed as she is? And honestly, I was having a hard time getting there.
I'm eccentric, not weird,
Well,
just for the record.
Okay.
Well, I want to add something on that before I jump into the other point. Is it's gotten worse, because now you're not competing against people with more discipline. You're competing against computers.
Right.
And computerized trading has changed everything, because computers, what's the one complaint they have on AI? It can't get humor. It can't get context. It can't get nuance, right? Computers don't have emotion. It is strictly data, boom, and it can hit it so fast and reverse things so fast that if you are not extremely disciplined to the point of almost robotic about how you go about things, your emotion, because we are emotional beings, will eventually creep up and you will lose, because the system, the faceless system these days of computerized trading has made even that chance that the market makers and the human traders on the other side would have eventually succumbed to their own emotion go away completely. And they just have all the cards. The one, I wanted to kind of talk about on that aspect of a couple things. First of all, a little history lesson, since we're talking about options here. A lot of people know about hedge funds. Names like Carl Icahn, Bill Ackman, Druckenmiller, Tepper, Cohen, Dalio, Soros, etc. Okay, a lot of names out there, and they have become extremely famous for two things. Number one, they're very disciplined, which is good, but they also are very speculative for the most part. And so most people, they run hedge funds. Most people think of hedge funds these days of that speculative shorting the market. Soros is going to go in and he's going to short the market right before the Great Recession, etc. The irony, and this goes back to what Kirk was talking about, is that it's fascinating to look at the root of hedge funds, because originally these were all about true hedging, using tools like options to control risk and protect capital. Mm-hmm. Now, when we hear hedge fund, we think of these high stakes speculation, this massive leverage, chasing returns. The word hedge has almost become ironic. It's a reminder of how easily strategies meant to manage risk can actually morph into something entirely different if discipline is lost. Sebastian Mallaby wrote in his book, More Money Than God, in 2010, Hedge Funds and the Making of the New Elite, where the hedge fund was coined in 1949 by Alfred Winslow Jones, credited with creating the first hedge fund that combined long positions, buying stocks, short positions, selling stocks he expected to drop. The core idea was to hedge risk, hence the name. Over time, those hedge funds expanded into using option strategy as a key tool to hedge market exposure by selling covered calls to generate premium income, buying puts as downside protection, and using spreads to cap risk and reward. There's still risk mitigation in there that was originally focused, not speculation, and the entire purpose was capital preservation with moderate steady gains, much aligned with discipline and systematic trading. Now, that has obviously changed with a lot of these modern managers who are now, these hedge funds, who's allowed to get into a hedge fund? Not the everyday person that's trying to manage risk. It's only what they call sophisticated investors, because you've got to be able to manage this incredible amount of volatility that was never intended in the purpose of hedge funds in the first place. But I just want to circle it back to the discipline side, because everything we're talking about in that discipline, there is a battle that goes on in discipline that you still need to be aware of. Okay. And this, I think the perfect example is the Herbalife saga. I don't know if anybody
Yeah.
remembers
Oh
this.
yeah,
It,
wow. I
it
haven't
is
thought of
the
that in a while.
it's the perfect
Yep.
case of discipline in the markets,
Right.
but it also shows the fine line between discipline and stubbornness. Now, in this scenario, you had Bill Ackman and Carl Icahn. Ackman had a plan. He stuck to it relentlessly. At some point, his identity actually got tied to the trade, and that's where the discipline turned to danger. Now, Icahn, on the other hand, stayed disciplined to the opportunity, not his ego. He took profits and moved on. I think that's a huge lesson in trading. The discipline was knowing when to, it's like the Kenny Rogers song, know when to hold them, know when to fold them, know when to walk away, know when to run. That's kind of what happened there, because the takeaway from Herbalife is that discipline without flexibility becomes a liability. You need conviction, but you also need an exit strategy. What happened, just in very, very short, Bill Ackman believed Herbalife was basically a pyramid scheme. He bet $1 billion short against it. He engaged in aggressive public relations to bring it to regulators' attention, to get the stock down to zero. He was definitely disciplined in his conviction. He held the short for 5 years, even though the market moved against him, and eventually double-crossed into stubbornness. He lost $500 million on that trade. Now, Icahn, on the other hand, saw the opportunity to go long. He publicly sparred. He called Ackman a liar and a crybaby. Where his position was less about business, Herbalife's business model, more about squeezing Ackman. This became personal. He increased his stake to 20% of the company. That actually countered what Ackman did and added confidence to the market. It drove the price up, and it made Ackman's short extremely painful. So keep in mind that when we talk about discipline, we're not talking about stupidity here and stubbornness. There is a point, and this is where every trader that knows what they're doing knows this. There is a point you do need to cut your losses. You need to recognize when your decision is not going to, is not going to go. I mean, go back. It's the old stake of going to Vegas, right? If you're going to gamble, figure out what you're going to gamble with and know when to walk away from the table. Because what happens, the horror stories of Vegas are when you continue to think that trade's going to come back, you keep doubling down until the zero isn't what you bet in. The zero is your bank account. I'll go back to what I said.
Mhm.
The markets have have one thing that will always come true, and it is basically the fact that you can end up with with bankruptcy, right? That is that, so there's a balance there. Take your emotion away, but also going back to discipline, know what your parameters are and know when it's time to just call it quits. Sometimes you're going to lose.
Doug, as that's amazing, and so many things are kind of popping through my head right now. But one of the connections I want to make, so I'm a behavioral economist and have been for a long time, and we talk a lot about this with both my clients and with students, which is the whole notion of what's called a commitment device, and that's sort of the name of something that behavioral economists use all the time, and has gotten some fame in the behavioral economics geeky world. But the point is, it's not just about having the discipline, it is creating a device that enforces the discipline. So it's kind of like that funny Greek story, the guy being tied to the mast so he could hear the song, right? That's a commitment device. And that's sort of what I teach them, is like, look, if you're going to go to Vegas, put $200 in your pocket and that's it. That's your commitment device. That is it. You are done. If that empties out, you are done. And that's what we kind of try to get to, because it's like one thing to say, be disciplined, but that's so hard sometimes, unless you have that sort of hammer that's just going to enforce it for you, even when you just desperately want to hear the siren song or whatever.
Yeah. I couldn't help to think how many people get attracted to the idea of high reward strategies like selling options without realizing the level of discipline that's required to survive long term. It is not for the faint of heart. The people who chase the biggest returns without the deepest discipline are ultimately going to be the first ones out of the game. Okay. So I wonder, when listening to this, how many people could try to replicate what she's doing or what traders anywhere do without really understanding the true mechanics behind it?
Yeah. That's a good question. You know, it's funny. You were talking about Herbalife, Doug, and where my head went to, it's a parallel story, but a great story too, is the Michael Burry kind of a Big Short story that Michael Lewis made so famous. But sort of a similar thing, except instead of two guys going against each other, there's like one guy in a garage or whatever, Michael Burry, going against an entire one of the biggest industries on the planet, the housing industry. And somehow he created a short strategy and was able to wait it out, right? Which is nuts. He actually won. But when you look at his story and how he won and how he almost had to defraud his investors to keep them from pulling their money, you know, it's a crazy story. I'm sure today he looks at it, or I don't know if he does or not. He's still alive. You know, I don't know if I would have done that the same way again, but I'm glad it worked out because I made a ton of money. But, you know, just it kind of goes back to the whole idea of making time your friend. It's like one thing, it's like the old saying that Keynes said, the market can stay wrong longer than you can stay solvent, right? And to me, it's like to know that the housing market is wrong, or to know that the Herbalife situation, that it's just wrong somehow. The problem is time. You don't just have to know it's wrong. You have to know how long it's going to be wrong for. And that to me is always and that's what I struggle honestly with options. It's the same thing. Even if it's a leap, 30, 60, 90, it's not about knowing the direction of the stock, it's knowing when it's going to happen. And that's to me which makes what makes options or other derivative trading so challenging, is that just that time component is a bear.
Well, I think
Well,
it's real quick. So, I mean, by the way, that's one of my favorite movies. I love that movie. And I think this is what makes shorting so hard, and this is why some of the best, like Jim Chanos, is arguably one of the best investors when it comes to shorting in the world, is because of the time element. And it could go up 100% before it goes to zero, right? You look at what happened with, you look at what the meme stocks, right? You look at those companies which arguably were zeros, and AMC and GameStop and like the companies like that, like these are hedge funds that arguably thought they were going to go to zero, and at the time they might have, but because of the individual investors who were like, screw the big guy, and I actually appreciate that they were able to do it, because it's crazy to think that mom and pops could get out there and screw the big guy with billions of dollars, but that's the danger, right? Is those funds went bankrupt because effectively they were wrong. You could say they were right, but it doesn't matter if you're right, because if you're wrong and you get bounced out of the trade, you're wrong, right?
Yeah.
It's not about, like, you might be academically correct, but academics is not what makes you money. And I think that's what a lot of people miss, is it's not the academia that makes you money. It's understanding the markets better than anyone else, and the markets do not operate on an academic measure. So I think what a lot of people have to understand is that shorting is dangerous. Options are a way to short with less risk. So, for example, let's say you bought the S&P and you'd owned it for 10 years, and you're like, you know what, I think it's getting a little risky. I want to protect myself. I don't like stop losses. So you just buy a put. Buy a put out there, and it's going to cost you some money to buy that put. But if that put's going to protect you from losing half your stuff, well, maybe it's worth it, right? And you need to make that determination. And so, if you think about it, it eats into your gains, but it also protects your gains as well. And I think when it comes to options, that's why you have to really understand them. You can't just willy-nilly do stuff. You have to understand how they work and the trade-offs, because the market will go up or down. It will go up more than 10% or down more than negative 10%, 70% of the time. And 30% of the time, it will go within the range of positive 10 to negative 10, within the middle. And those are statistics, right? And investing is about probabilities, in large part, because that's how people trade. They trade options, they trade futures, they trade derivatives on probabilities in a lot of ways. If you look at options, you can tell what is the probability that my option is going to be worthless or it's going to be positive. they call them the Greeks. I won't go down the rabbit hole, but there are ways to determine that based on what the market is predicting the probability is. So as long as you understand that, you know the risk you're taking and you can make the determination if it makes sense. That's why the math is important, right? It's not a binary yes or no. It's a, does the money add up? And it usually, if you think we're in efficient markets, and we're not always efficient, but generally,
Ever. Sorry.
yeah, ever. But if you think we're efficient markets, then at any given time, you know what your chances of success are just by reading the market. Now, of course, it's wrong a lot, but academically, you can determine, okay, my chance of success is 30%. Do I want to take that? Now, Michael Burry, his chance of success were not even calculated, right? It's like when Tyson fought, who was it, Buster Douglas?
Buster Douglas, Columbus, Ohio.
You could not get a bet on that fight. It was so one-sided in Tyson's favor. Vegas would not even take bets because the odds were not even on the charts. They were completely off the charts. They wouldn't take bets, and of course Tyson lost. But there are circumstances where this is crazy. Those are the ones you want, right? You want to take those bets because eventually you're going to get one right. And if you calculate it right, then you can make lots of money. But I'm not suggesting you take long shots. But certainly if you have an edge, there are times where the street's wrong. And if you can find those opportunities, and that's where you make your money, is determining where everyone else is wrong and you're right. Now, you got to be pretty smart to know you're right and everyone else is wrong, because there's a lot of smart people out there. But there are a lot of lazy people out there too, who are doing things. They don't actually do the work. They're just like, yeah, Apple's been going up for 10 years. It'll probably still go up. So they're not actually doing the work, right? They're not looking at it and saying, oh, well, this, and this is happening. Maybe I'm wrong. They're just saying, well, everyone else is doing the work. I'll do it. So when everyone says someone else is doing the work, that means no one's doing the work. And that's why you have these discrepancies in Wall Street. And that's where you can make good money if you're doing the work and you understand how the system works. So anyway,
it's funny. Go ahead, Doug.
You go ahead, Jeff, because once I get started.
I just want to just a quick comment on what Kirk just said, which is so funny, because I think of being smart, right? So to find something that nobody else is doing, or that you're right and everybody's wrong. But I look at it a little differently. I look at it through the information lens. I look at it as information incentive, the two eyes of economics, right? And so, but I look at private information, right? So is it about being smart or knowing something that nobody else knows? And so for example, I look at with Congress right now, all of our Congress people are starting to get flouted out with their trades where they got private information. Gee, it's easy to get rich when you know something that nobody else knows. And you do trades, right? So I do wonder about smarter private information.
Yeah. Well, so for those of you that don't know, that have seen me with Kirk before, I'm actually born and raised in Columbus, Ohio. So yes, the Buster Douglas thing is something we're very proud of. And you talked about betting on it. I just wanted to say this. In 2002, I was at the national championship against Miami Hurricanes, and we're going into double overtime, and this guy is pacing. Like, he looked like he was going to have a heart attack. He actually said to me, I said, dude, are you going to be okay? He's like, I bet $1,000 on Ohio State winning the national championship before the season. Before the season, the odds of Ohio State winning were 1,900 to 1, which meant that he was sitting there waiting for them to win $19,000 in profit. So, it's like that Buster Douglas trade bet you're talking about. This time Vegas actually allowed it because it was so far in advance. So he walked away happy for a number of reasons. But total segue. I want to come back to the Michael Burry thing, because I love that you brought that up. The thing about Michael Burry that I think is a great segue to what to talk about is it talks about the dark side of discipline. Yes, it's another example of him making millions, but at a cost of trust, health, peace. The line that many have to manage as traders: what does discipline serve, and when does it isolate? I mean, he had extreme mental and emotional toll. I mean, he got threatened with lawsuits from his investors. He had become deeply mistrustful of the financial system. He was almost too early. So there's the liquidity and timing risk that comes into play, because again, like you said with John Maynard Keynes, it's going to be irrational longer than you can remain solvent. He blocked investor redemptions. He damaged his reputation and relationships. But ultimately, the other thing too, which you asked is he still around? Oh yeah, he's still around. He pulled back from public investment a long time. He had that win. I think this is a real takeaway too. Sometimes it's discipline. A lot of times it's luck. Okay. And he saw something and he was lucky enough to be able to hold out and stay solvent long enough to see it come to fruition. He made about $100 million eventually for himself, $700 million total for his investors. But after he pulled back, he started coming back, and around 2001, or I'm sorry, 2021 ish, he started coming back and started to predict massive. Again, just like he did with real estate, we're in a massive stock market bubble. He compared to the greatest speculation bubble of all time. Yet the markets rallied in 2022 before correcting. In 2022, he came back and warned of a crash due to inflation and Fed's tightening. Well, there was some correction. No full-blown collapse happened to match his dire warnings. In 2023, he took large short positions against the S&P and NASDAQ through put options. Revealed in public filings, they closed them quickly at a loss or minimum gain. Ultimately, the S&P in 2023 ended up 24%. The NASDAQ rose 43%, making his bearish stance painfully wrong. So this is a guy that's, revered for The Big Short, has a movie around him. Guess what? Since then, now he's called a perma bear. He's always calling for collapse. He's over-rotating his previous success into constant doom forecasts. He makes public bets that don't materialize. Ultimately, he's been, the next crash is around. Is he right? He might be. It might be finally coming. He might have been early again, or he might be dead wrong. Unfortunately, now this approach that he's taken, what we can take from it is that discipline, again, isn't about holding one stance forever. It's staying committed to process, but also you still, and this is where there's the fine line between discipline and flip-flopping, okay? You still need to stay flexible enough to evolve when the facts change. Right. I hear this all the time. We're on a podcast, right? I listen to a lot of talking heads, especially in sports. And, most of the people that comment are idiots. I'm sorry. They are. There's a lot of things that are like, oh, well, you're saying this now, but you said this then. It's like, yes. And these podcasters, these talking heads, these sportscasters are always saying this. Yes, I did say that then with the data I had. I'm not flip-flopping. I'm not changing my view willy-nilly. New data came out, new information, and now I'm telling you something different because I have new information to go on. It's like we want people to be flexible. We want them to be on top of things, but then we're willing to just trash them when all of a sudden they say something different than they did in the past because, yes, they're evolving. They are actually taking new data. You have to do that. That is different than not being disciplined. That is actually being educated discipline. I am taking my discipline, but as new information evolves, I'm applying that new information to stay disciplined, but to adjust with different circumstances. And that is, of all the things we've talked about today, I personally believe that's the hardest thing. For even beyond emotion is understanding how to continuously learn, continuously evolve, and continuously adjust to apply that. I think that is the biggest risk people have because we are tired, we are stretched, there's information's coming at us faster than ever. It is harder and harder to stay on top of it, which means the chances of you being disciplined and correctly disciplined based on the information you have, and that information changing is getting faster and faster to the point that you're outdated with your approach sometimes as quickly as months. And I think that's the biggest difficulty for anybody sitting at home to be able to do this. I go back to the computerized trading. It's getting harder and harder without all the tools to be able to be successful.
Right. And if you think about it, Doug, it's like the computers, like you talked about the struggles of, I got new information, so I changed my perspective. That's what computers do. They are belief updating machines.
They can do it on a daily basis.
They do it on a
look at the bets that are out there.
A second basis. New information came in. Boom.
Yeah, that's where you lose because they'll see all the options. The computers read the options that are posted and bet against it right then and there. And
Yeah.
that's where they squeeze you. And so, all I can say to everybody is extreme caution, because it is a very, very difficult world to play
Right.
and adjust and be successful.
Well, and
Well,
I think about too is like, so one of the big things going on, trends going on right now, which I'm really disturbed about, are the betting platforms. So if you look at our kids, or I shouldn't call them kids, but so I'm in my 50s, my children are in their 20s. So I'm thinking about that next generation, their age. There's a massive movement towards the betting platforms, right? And, you know, even if here's the funny thing about that, because we're talking about like finding the edges and being right when everybody else is wrong, and whether you have private information or whatever. Here's the problem with the betting platforms. Even if you are that sharp, that smart person, whether you are that sharp or you got private information, what the betting platforms do now is they limit your trades. So even if you figure out, whatever, it's going to land on 21 black. I have this information. They'll only let you bet $2,000. So I told my students that is the colossal waste of time to spend all your time getting super sharp, super smart, and they're going to cap you. So why would you waste your time on that?
And
well,
the
wait, hold on.
hyper
We gotta
and
we gotta we gotta wrap it up in the interest of
well, I'm
time.
just going to say this last thing. The hyper
Do part of your
accessibility to
final
betting
thoughts.
platforms too is dangerous. So I'll leave it at that.
Yeah, I'm going to make one point and let you guys wrap it up. You can say what you need to. So one thing, actually, Michael Lewis has a podcast where he talks about this, where the betting platforms, FanDuel and DraftKings, is that if you're good, if you're successful, they will actually kick you off the platform. So his comment he made was, he's like, find out if your financial advisor uses one, and if you do, go find a new financial advisor, because only losers use those platforms. So it's like they will only accept you if you lose money. It's like, it's crazy. It's a good episode. Anyway, let's wrap it up. Jeff, final thoughts from you, and where can people find more about you?
Yeah, no, this was great, and you guys are. I always love talking about this, and you have some great guests. So thank you very much. So basically, if you're looking to take control of your financial future with confidence, check out Personal Finance Reimagined. We go beyond traditional financial education by providing a consistent, repeatable decision process to help you make smart choices, not just with money, but across all areas of life. Whether it's investing, career moves, or major financial decisions, our approach gives you the tools to succeed. So you can connect with me on LinkedIn. You can come to our website, financerevamp.com, to learn more.
Awesome. Thanks for coming on. And Doug, final thoughts from you. Where can people find more about you?
Well, I appreciate it, Kirk. Again, always a pleasure. Nice meeting you, Jeff. I am the founder of Mergent College Advisors, MERGENT. Always have to spell that out, MERGENT, mergentcollegeadvisors.com. We're designed to help families approach college with a clear strategy, integrating the entire admissions and funding process into the broader financial plan. We focus on how college decisions impact long-term wealth, retirement, and cash flow. We find tax strategies. We look at ways that families can go to college without just, making sure the students get into the right school, but also protect their financial future. It's all about disciplined planning, minimizing debt, making education a smart investment within the bigger picture of financial health. And we have a unique approach to doing that, helping you to find money that you're losing through wealth leaks unknowingly and unnecessarily. Something I know many of you have not heard about or looked at. Ask us about our financial GPS. Reach out to us, get some more information, mergentcollegeadvisors.com.
Great. Well, thanks for coming on the show. Thank you both. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.